Hey everyone, coinmetallurgist here. Um, I've been wanting to make this video for over a month now and just haven't had the time to sit down when it's quiet to make it at my computer. Um, all of the numbers that I present in my PowerPoint presentation are a little outdated because I um, made this presentation beginning of December. But what I want to present to you today is just kind of my views of using the gold-silver ratio to increase your quantity of gold and silver that you've purchased and invested, and just kind of what I kind of view as how efficient it is, or why it would work, or how in what situations it would work. Um, kind of got inspiration for doing this from watching two videos that Silver Slacker posted in the beginning of December. These are the names of his videos. If you want to go look at them, go ahead and do that. I'm going to kind of try to present this from the get-go, where you don't need to watch his videos necessarily before you watch this one. But his videos are also, show his opinion of this and are really informative as well. So first off, let's just go over calculating this ratio and kind of what it is. So essentially, we take the spot price of gold and we divide it by the spot price of silver, and that's our ratio. So just an example, and I know this is using an older date for the prices, but that's just, we're going to use those numbers throughout the whole presentation. Okay, so on December 9th, here's what the spot price of gold was and the spot price of silver. We just take those two prices, divide the gold by the silver, and we get 68.8. So that's our ratio. So what that means is that on December 9th, we could have traded 1 ounce of gold for 68.8 ounces of silver, and they essentially were worth exactly the same amount. Now, the data that I was able to collect was monthly average spot prices, and I was able to find this data actually pretty far back, but I'm going to use data from January 1985 to November 2016 to kind of build a scenario in this presentation, like what if we were to have invested this money, say we had a large amount of money in 1985 and we're like, oh, let's go invest it in gold or let's invest in silver, what should we do? So I'm going to kind of go through three options. What if we switch back and forth the investment from over that course of 30 years? What if we just leave it in gold? What if we just leave it in silver? How would we be doing today? And what are the differences? So this is that same data just converted into the ratio. Month 0 here is January 1985, and we're going all the way to November 2016, so it's 383 months on that axis down there. I've also added in two horizontal lines here. The lower one is gold colored, and why that one's important is when the ratio crosses that line is when we'd want to trade silver for gold. So basically, I set these lines at arbitrary ratio numbers. We could have set them at whatever we wanted. I think I used the same ratios that Silver Slacker used. You'll have to watch his videos to make sure. I'm not 100% sure on that, but they're just kind of based off the historical data. They're kind of the high points and the low points, and I know it goes higher and it goes lower, but not regularly. So basically, when the ratio gets low enough, you can get more gold for your silver, and so you want to switch your silver back into gold, sorry. And then when the ratio gets high enough, you want to trade that gold back into silver. And I'll explain this more as we go along. But those arbitrary numbers that I set this at are 50 and 75. So that gives us a bunch of different events when we switch between gold and silver. So I'm just going to go over the dates here, and then I'll go over what we would do at each event. So our 0 dates, January 1985, and October 86, December 97, February 2003, April 2006, October 2008, December 2010, and then finally July 2015 would have been the last time we make a switch. Okay, So I just want to go over in more detail what we would be doing in each one of these hypothetical moments over the last 30 years. Um, so basically what we're just going to use for our situation is, say we had a large sum of money in January 1985 and we wanted to invest it. I just picked the amount of money that it was equivalent to 100 ounces of gold at that point in time. So we had $30,285.20, and we used that money to buy 100 ounces of gold. Okay, and then in October '86, that ratio increased to that 75. So as soon as it hits that 75, we trade that 100 ounces of gold to 7,500 ounces of silver, and the value of that, of either that gold or that silver at that point, is now $42,335. Now I understand that, you know, when you would sell your gold, you wouldn't get necessarily 100% of the value, and when you buy the silver, you might be paying a premium. But we're just I'm just doing it real simplified and not accounting for that in this data. So then, you know, it goes back down and it crosses that silver line again, like right up here. But we don't care that it crosses that silver line again because we're still invested in silver at that point. We only care when it crosses that gold line again. And see, if you were to have, you know, stuck with it longer, you could have, you know, traded your gold to silver way up here when it gets almost to like 100. But you can't, you know, can't predict exactly what's going to happen in this ratio. So then in December 97, we're going to trade that silver back into gold to 150 ounces of gold. And its value didn't increase very much, but now we have 50 more ounces of gold than we had. In February 2003, traded back to silver. It's increased about $10,000 in value. Trade it back into gold. And you see every time we trade it into silver, we're getting 75 ounces of silver for each ounce of gold. Every time we're trading it back into gold, we're getting 1 ounce of gold for every 50 ounces of silver. So the quantities of gold and silver is increasing every time. And the value increases because the spot prices are increasing as well. So then we trade gold back into silver. We're at over $175,000 of value now. December 2010, trade it back into gold. Now this is when the spot prices are going insane, so the value is ridiculous. If we all would have known that spot prices were going to go ridiculously high like that and then crash back down to where they are now, I'm pretty sure all of us would have sold out at that point and rebought back in. But that's hard to have known. And then in July 2015, trade the gold back into silver, and we end up at the end with, instead of 100 ounces of gold, 337.5 ounces of gold, or if we have it in silver, which is where we should be if we're following this, 25,312.5 ounces of gold. So you can kind of see from this chart that the quantity of gold and silver would increase. And you see, this is over a period of 30 years. This is not kind of a quick go back and forth between gold and silver. This is a long-term kind of investment type idea. So let's look at the alternatives. If we were to take that same amount of money and have invested it into gold and just left it in that 100 ounces of gold, or if we would have invested it in silver and just left it in that silver. Here's kind of just a graph of the value of that 100 ounces of gold. And here's the same graph as if we would have invested that same amount of money in silver and what its value would be. I'm going to overlay those. So we can see that we did make money, and I just want to kind of get a better idea of what's going on here. So for the gold investment, the present value of that 100 ounces of gold, and this is off of like December 9th numbers, just to keep that in mind, that's $124,000. So we started with what, like 30,000, so we definitely made money. So our average annual interest rate was 4.425%, which is pretty good. And then our present value for silver investment is $86,607. So we didn't do it quite as well with the silver if we would have stayed with the silver. So almost 3.3%, and that's annual interest rate. So that's the amount of interest average you gain over that course of that 31 years or so. Now, of course, some years you're going to do a lot better, and some years not as well. Now, if we would have done that aggregate where we're switching back and forth using the gold-silver ratio between the gold and silver, the present value of that investment would be $440,000, over $440,000. And the interest rate, average annual interest rate would have been 8.42%. So I hope that this is sufficient to convey to you that by using that ratio and switching back and forth, the amount of interest or the amount of money that you'd gain significantly increases. You compare just the raw value to the value as if you would have left that money in silver for 30 years or would have left it in gold for 30 years. You're doing far better. And the idea is that, say even you had a period of time where the spot price decreased significantly, you're going to be doing a lot better if you have 337.5 ounces of gold than if you have 100 ounces of gold. So the spot price would have to dip significantly for you to be losing money. So it kind of puts more security into your investment, and you're constantly, or not constantly, but periodically, every time that the ratio gets to your control limits, you're increasing your investment. So just going back here, just keeping in mind, we started with 100 ounces of gold, and we finished here with 337.5 or 25,000 ounces of silver. So, I don't think anyone would say, no, I don't want to take my 100 ounces of gold and over 30 years make it into 25,000 ounces of silver. We're basically getting there over 250 ounces of silver for each ounce of gold that we purchased originally 30 years prior. Now, and I understand probably none of us have this $30,000 to just invest right now into gold or into silver. I certainly do not. But I think this is just kind of a unique and interesting way to think about it, and I think if we apply this, we could definitely improve, especially for the silver stackers and those people out there. You could improve your investment over, if it's a long-term investment, you want it kind of as your retirement or something to just be sitting around. The other thing to keep in mind is why you're buying into this gold and silver. Going back to here, even an 8.42%, I'm pretty sure that you could take your money and easily put it into the stock market or put it into different investments to get a better interest rate than that. So if you're purely interested in getting the best, investment or on your money, then you wouldn't necessarily do this. You might go in a completely different route. But the idea with this is that the reason why people buy into gold and silver, at least in my view, is that it's kind of more secure. It's more of a hedge or a barrier against like hyperinflation or natural, like large disasters where you can't get cash or cash isn't available. And really, in my mind, the big thing is that hyperinflation. You just want to have something to where if hyperinflation did happen, you have a investment against it to where you're not going to lose all of your wealth. So I don't think that people who are investing highly in gold and silver are 100% worried about this interest rate, but they're more worried that they want it to hold its value. And in all three cases, the gold, silver, or using this aggregate of the ratio, you're holding your value. But um, the the true idea here is that why not use that ratio to your advantage and increase that value over time, rather than, or kind of spark it along the way, let it to allow it to increase um, more rapidly. um, and it doesn't matter what the actual price or value of gold and silver is at any moment in time. You just look at that ratio and you keep track of that ratio, and when it switches back and forth, or when it hits whatever you set as your control limits, then you can switch back and forth between the gold and silver, and uh, you can increase the total amount of gold or silver that you have on hand. But I hope that presentation was helpful to you. I hope that kind of explained what the gold and silver ratio is and how it could be used. Now, I don't know, what's going to happen as far as the future, but I'm just basing these ideas off the past and assuming that the future should hold similar trends to the past, and that's why I set those control limits to what they are. But go ahead, do your own research, look into it, see what you think. Let me know. I think at the Perth Mint, you can get a lot of the historical data for gold and silver from them in an easy to use format. I think it's like CSV or something. But thank you for watching. Sorry that was a pretty long video. I hope it was somewhat enjoyable and not too dry. But I appreciate all of you guys, and have a wonderful day.